bonnets of cars, and it has done something to my Wi-Fi. So I'm just on audio today rather than video. So that's probably a good thing for everybody. Um, Oil prices, of course, are trading a little bit down this morning in Asia. Brent is at 81.89 and WTI at 76.54, down a third of percent. But after a big momentum last week, we saw a 6% jump in the oil price through last week and somewhat stable this morning. Omar Najia, Global Head of Derivatives at BB Energy, kicks us off every Monday morning. Omar, your thoughts at the moment? Still sort of bouncing our head off $82 on Brent and sort of bouncing off the floor at 77, 78 whenever it drops down. Your thoughts on the market this week?
I think basically we're going to take out 79.26 on TI, which is plus or minus $3 higher, probably go a little bit higher than that. I like all markets, most of them. I think the world is inflationary, whichever way you want to look at it, stagflation, inflation, whatever. But I don't think you get a recession when the US has a budget deficit of $2 trillion a year and growing. And I think basically that, you have these wars. Today I read a funny headline on Bloomberg saying oil prices dip as Iran says, the war in Gaza will be sorted out diplomatically, which made me laugh because, the dip is about 20 cents or 30 cents. But at the end of the day, nothing is going to be sorted out diplomatically. Absolutely nothing. There is no going back. There is no status quo. This is only going to get worse and worse and worse and worse. So I think they're trying hard to kind of, use sticky tape to paste it all together and hope that it looks okay. But I think we're going to hell in a handbasket. I think the U.S. election is going to be very interesting. I don't know what happens to Trump. I don't know if he gets, honestly, I don't even know if he'll get shot or arrested or put in jail or whatever it is. I mean, it's just incredible. I've never seen a world like we have now. I've never seen the US so unstable. I've never seen the Europe clueless. I've never seen the UK have like a prime minister that was not kind of elected. It's a complete disaster, I think. So I'm not looking to sell anything, and I'm not
Well,
looking to hold cash either.
the oil price sits with all of that dramatic backdrop, but doesn't seem to show any of its stress. Clyde Russell, Asian commodities and energy columnist at Thomson Reuters. Clyde, we have some stats out of the China, the consumer price index there continues to decline. Deflation is a concern. We have reports now, latest data on car sales. The prices are falling at the fastest rate in nearly 25 years in China. From a demand point of view, what does that look like? It seems to be sober for the oil price, but not too much.
Yeah, China's a very interesting place at the moment because if you were bullish, you could find a few indicators to support that view. If you were bearish, there's plenty out there. I think if you're trying to separate it all out, there are parts of the Chinese economy that are traveling okay and others that are not doing that well. So if you're looking at the parts that are not doing that well, you've had residential construction. You now appear to have a little bit of a hiccup with vehicle sales, which had been a point of strength. But the overall theme is China is actually in deflation. It is exporting deflation to the rest of the world through cheaper manufactured goods, notwithstanding the increase we've seen in shipping rates because of the issues around the Red Sea. As far as the oil price goes, I tend to look at China through the prism of they tend to buy more when they see prices are relatively low, and they pull back from imports when they see prices rise. So you've got to remember that right now, January, February, what we've been seeing is oil that was bought in October, November, and that oil was actually relatively cheap. So arrivals have been strong. You saw 11.4 million barrels a day in December. The tracking services are looking more at about 11.3 million barrels a day in January. That's still quite high. There may be a bit of pull forward in January because all of Lunar New Year falls in February this year, which may trim February numbers a little bit. But overall, what you're actually seeing as far as oil demand goes is you're seeing quite strong numbers out of China, which is a reflection of the fact that they bought when they thought the prices were lower. If the price does go back up, it's consistently above $80 and heads towards 90, I mentioned that 3 months lag, you'll see Chinese imports drop off again.
Brian Perry, founding member, Energy Rogue, and has the pleasure of living in beautiful Colorado, where we all wish we could go every now and then. Brian, we're seeing U.S. oil production on the supply side, demand weakness more or less in China, perhaps, but demand or supply strength in America. We see another back to record level, 13.3 million barrels a day. Your thoughts for the outlook of that supply as we move through the first quarter?
Yeah, I'd probably say I'm a contrarian as opposed to most analysts out there are expecting growth in the United States and growth out of the Permian, which is one of the key producing basins in the United States. I'm seeing signs that we're treading water. We grew from 11 million barrels a day up to 13.3, 13.4 million barrels a day. That's a lot, but it took 3 times the rigs to actually get that growth. So we had a 300% increase in rigs to increase by 18%. And since June of last year, we've actually dropped a significant amount of rigs. So our growth engine is slowing. And every month
we did see the rig count jump recently, didn't it? It's back up. The rig count,
not significantly. It is creeping up, but there is some increase in Canada, and that's actually really interesting. I think it's to fuel some of the exports on their LNG out of Kitimat. So I think they're chasing more gas than oil there, but the rigs have crept up, but it's not significant enough. We've had a 25% drop. I believe that's the case since June. So that growth engine is starting to slow down, and every month the United States declines by 600,000 barrels a day. So that means we have to add in new production over 600,000 barrels a day because newer production declines at a faster rate. So when I think about 13.3 million barrels a day and we decline every month by 600,000 barrels a day, that puts us on a treadmill. And if you reduce the number of rigs, we actually are increasing the speed and the incline on the treadmill. So it's going to become harder and harder for the United States to stay flat. So I think OPEC is projecting a growth of maybe 400,000 barrels in the Permian for 2024. I'm actually expecting the United States and the Permian to decline this year. So again, I'm probably a contrarian there, but I'm starting to see leading indicators of that treadmill catching up to us.
Omar, I wanted to get into a little bit about your outlook for, obviously, as you mentioned in your opening comment, there is signals of at least over the weekend, some suggestions that perhaps the Israel's war on Gaza is there a pause? Maybe not. You're saying this is going to get a lot worse before it gets better. Ultimately, my question to you, Omar, on that is that sort of forecast, that outlook for things to get better or worse before they get better, is that bullish or bearish for oil prices?
Well, I mean, indirectly, it's bullish because wars are expensive and wars are inflationary. So, yeah, I think basically, I mean, the Israeli-Palestinian kind of thing that's going on doesn't affect oil prices, but what does affect oil prices is, for example, the Red Sea delaying everything by 2 weeks or more, and that kind of the geopolitical picture in general, whether it be Ukraine, whether it be Gaza, is extremely bullish. I mean, I've been hearing the same thing about China being, collapsing and I don't know what and blah, 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 blah. Last week or a couple of weeks ago, there was Evergrande, basically, this company. They're going down the trail. They're going to be, dissolved, bankrupt. I don't know what happens. Absolutely nothing. Absolutely nothing. I mean, if you want to look at
Chinese equities are having a fairly difficult window, while obviously,
let me explain. So, Nvidia on its own is worth more than the entire Chinese stock market. Now, what do you want to buy? the entire Chinese stock market or Nvidia. I mean, people make these decisions. You want to buy Nvidia, go right ahead. All I'm trying to
But just
explain is
coming back to
I
the
wouldn't.
conflict, yeah, coming back to the conflict in the region, and obviously we have, fires as we've seen of the Red Sea. We have obviously the traumatic tragedy in Gaza. We have the sparks in Syria and Iraq and so forth. If this was escalating, and even in its current shape, I mean, personally, I'm kind of starting to be confused as to whether it's bullish or bearish for prices, because it doesn't seem to be bullish. So if it escalates, it has a macro negative economic consequence. I'm just wanted to get your
No, no.
insight, your sort of thoughts on that.
You have to be very careful by it. I mean, markets work on sentiment. They don't work in 1 + 1 = 2, honestly. So basically, market
Yeah, but the
sentiment.
conflict sentiment is not bullish in this equation. I mean, it might be $1 or $2, but it doesn't seem to be much more than that in its current state.
Okay. Well, I mean, you have to project forwards, right? So what happens
Right.
if there's a problem with Iran, what happens then to oil prices?
Yeah, I mean that's the
Okay,
escalatory nature.
so if the thing is escalating, I mean, you have to understand who's involved here. You have the West and Israel on one side, and you have Hezbollah, Hamas, the Houthis, and Iran on the other, right? And if you listen to some of the lawmakers in the US, all about, strike Iran, bomb Iran, cut off the head of the snake, all this kind of stuff, what I'm trying to suggest you is the following. If you want to sell because you think that this market is or whatever, for whatever reason,
Yeah.
then basically people will go ahead. But every day that this thing ratchets up, they get more and more nervous. And at some point, they're going to start running. And when they start running, this thing is going to explode to the upside. The US, I mean, what Brian was saying about shale, I totally agree. You have basically shale, it costs so much money to produce a barrel of oil. And with interest rates where they are, you can forget about it. You can forget about shale. But still people want to come back and, the US, I don't know what, blah, blah, blah. All these things are, interesting to talk about. But the bottom line is this market is about fear, and this market is about greed. And the people who are going to get frightened, they're not the lawns. The people who are going to get frightened are people who are shorting these markets. The S&P is over 5,000, right? How many times, our target is 5,900 for this year, 5,900. Why is that? If everything is deflationary and I don't know what and blah, blah, blah. Why? Because if you have cash and a lot of people have massive capital, you can't basically sit on it. So if you're looking at oil, you've got to either sell it or buy it, right? Because sitting on it is not going to do you any good. Same with the S&P, same with everything. What are you going to do? Same with the dollar. And what I'm saying to you is I want to buy it. I want to buy the S&P. I want to buy gold. I want to buy Bitcoin. I want to buy oil, and I want to sell the US dollar. Right? That's my view. People can take the opposite view, but what I have on my side, I think, is basically this fear and greed. I'm not fearful that this thing gets sorted out. What I think is fearful is this thing escalating. So what am I betting? I'm betting to lose $1, maybe 2, maybe 5. But if I win, I'm going to win 100. I'm going to win so big. So yeah, put the bet on the other side. Let's see what happens.
Clyde, looking at the other side, I mean, where we might see a weaker sentiment, more in the gas price than the LNG price than the oil price, what does the other parts of the commodity complex tell you about the outlook going forward, where oil might not be telling us and not being a very accurate signal of where we're going?
Well, I think first, I would say I agree with Omar in the sense that this is very much a headline sentiment-driven market at the moment. Fundamentals are a little bit out of the window because there hasn't really been any interruption to oil supplies. Yes, there's been disruptions in shipping, and that adds to the shipping costs, but that shouldn't actually really affect the price of oil that you see in futures contracts that much because they're pre-delivery prices and not delivered prices, so they don't reflect shipping. But if you were sort of looking at, what is the rest of the commodity complex telling us? It's not exactly that positive. If you're looking at other energy commodities, there's plentiful LNG around. You've seen the price in Asia remain weak over winter. There hasn't really been a seasonal spike, even though volumes have been strong. What's really happening there is you've got record exports from the US, record exports from Australia, and almost record exports from Qatar. So your supply has grown quite dramatically in LNG, and the demand, while it has grown, it hasn't grown by more than the supply has. So that's kept the spot price is muted. I mean, yes, warm weather in Europe has certainly helped. Wasn't a brutal winter in North Asia either, so that kind of has helped the situation there. But if you look at other commodities, copper, iron ore, coal, they're all telling you that things are sort of bubbling along, but not really giving you much direction. That's why I say at the moment it's all headline driven. And I think if you're actually looking at the stuff in the Middle East, yes, there's a fear that it ratchets up. But there's also the equal possibility that things just continue on, that Gaza remains the mess that it's always been, unsatisfactory, doesn't get resolved. What does that sort of scenario mean? I mean, if you actually look at it, I think there's been a lot of behind the scenes work, particularly by the Chinese. They are big losers out of this. Their manufactured exports to Europe get more expensive because they can't go through the Suez Canal. Their oil imports get more expensive. So they are telling their allies, turn it down. We don't want trade disruptions. And if you actually see, the Houthis have sort of calmed down. The Hamas didn't really get all the support it wanted from the rest of the Arab world. I tend to think that this is one of these conflicts that grabs headlines but doesn't really alter the fundamentals.
Brian, one of the other big questions inevitably is the outlook for the U.S. economy, which on the supply side of oil, you mentioned there, you're looking at a contrarian view that it's sort of neutral to negative in terms of additional supply this year. But the macro outlook for the U.S. seems to be somewhat confusing, i.e., is it in a very healthy state? It seems the sentiment in America is, despite full employment, record stock markets, that the economy seems to have a negative temperament to it. And the president and Biden and so on doesn't seem to be getting any wins from that. And the Fed rate outlook cuts now seem to be further away than nearer. Where do you intersect the sort of macro outlook for the U.S. economy and energy demand as we go into this sort of further deeper into this year?
I'll just piggyback off a point that Omar made, is that the value of the dollar is really higher than it ought to be, because it's underpinned by so much debt. And if you look at the consumer debt, if you look at the government debt, the United States really has a lot of debt to it. Relatively speaking to other economies, this is where it gets more complicated. Sometimes money flows into the dollar because it's a better credit risk than the alternatives. That's a wormhole that we could go down. But as far as the economy, I've expected a slowdown and recession, not the one that we've heard about the last 16 months, but dating all the way back from 2008. There's been this continual kick the can, quantitative easing, just expansion of money printing. And so when you look at that, everything is aligned inflationary. But if you take crude oil prices today versus 10 years ago, it's virtually the same. And as Omar and Clyde were referencing, I mean, the cost of other goods, the cost of other services, everything else is maybe 5 to 10 times that level. So crude oil prices, I think, are aligned for an upside. The U.S. economy is quite frankly a puzzle, because I think there should be a contraction. However, that contraction seems to be kicked down the road through new debt creation. So,
but we had this latest surge. I mean, if the equity markets are what an indicator of what, obviously typically they're an indicator of the future profitability of the companies listed. And the surge in the equity markets in the fourth quarter was very firmly on the back of the expectation that we were very quickly going into a significant rate cut cycle. And that's why all the equity markets surged, because inevitably that would mean more profit for the companies, more dividends, and all the obvious things. That has now been squarely been knocked off the table, and yet the equity markets are still soaring ahead. So what is the narrative? Like, what are they soaring ahead on now when it's going to be higher rates for longer? I mean, what does it tell us about the health of the American economy, or does it?
So I started my company Energy Rogue back in 2021, and part of the reason was in previous careers I had worked at several shops, and one shop was a company that was worth $5 billion, and they were funding an asset acquisition on the oil side of the equation. And I looked at the financing, and I went to the CFO and I said, you're layering on a lot of debt. I mean, essentially you're putting on a 17-year commodity debt. And he said, well, Brian, if you can borrow at 6% and make 9%, why wouldn't you? And I said, yeah, but the 9%, that's not fixed. That floats. You're borrowing 6%, which is set. The 9% floats. Sometimes it may be 2, sometimes it may be 10. You know, it's going to float around. So there's no guarantee. So I think when you look at the money flows, there is a lot of debt that translates to investments, and that gets back to kind of the premise that Omar touched on, which if you have cash in the bank, you've got to do something with it. You know, so where do you deploy that? Do you deploy that in this fund or this fund or this fund? And the United States housing market has so many paid off homes now that there's a lot of disposable income in baby boomers, and
Right.
so
That's an interesting baby boomer one. I think another rabbit hole one could certainly go down, because I
right.
do think it's quite a significant factor as to why the American economy is doing better than maybe the macro analysis would otherwise tell us. But let's go to the survey question and then sort of come back for a round of a more immediate, i.e., the next week, the next days. What does the world look like? So the question today is inevitably focused a little bit on what was Omar's opening comment or opening critique, which is the regional conflict. If indeed we are going into a some sort of an end game, hence the headlines over the weekend, is that bullish or bearish for prices? That's the question. And then we bring up that survey question onto the screen. We can all get a chance to tick our box on that. Did it come up? It didn't come up on my screen, but maybe it came up on others.
It did.
Yes, there it is. Okay. Omar, just looking forward this week, where do you think? I mean, last week we saw a big rally back up above 86%. We're starting the week in Asia a little bit uncertain, but of course it's very early doors. What do you think the week ahead looks like?
I think we need to get at least $3-4 higher before we pull back significantly, so higher. And the other thing I wanted to say is that if you look at the US, if you think that the stock market is going up because they're making money and it's a reflection of companies making money, what you have to understand is only about 7 of these companies are actually moving up and dragging the S&P up with them. The rest are not. That is not basically people putting money because the companies are going to basically make money. No. What that is basically a fear of holding on to cash. So if you fear holding on to cash, what are you going to buy? You're going to buy a very, very narrow set of 7 companies. And I would agree with that. And I would buy them, and I would buy them here, and I would buy them if they go higher, because they are, they are a quote unquote safe bet. But what it's showing you is a fear. People want to get rid of this cash. They want to be in something. And that is not deflationary. You can't have the US government spending an extra $2 trillion a year and have it be anything except inflationary. You
And
can't
can you
have the
have rate
US
cuts as well? I mean, to add fire to the,
even more,
fuel to the
even
fire.
man, big time, even more inflationary. So the US has all this debt, right? This debt means they pay interest, which is in itself inflationary, because all these people receiving that interest, what are they going to do with their cash? They're either going to buy Apple or they're going to buy Amazon or whatever, but they're certainly not going to buy, whatever GI engineering. It's just not going to happen. So yeah, I think basically it's going to be inflationary. This world based, this thing is going to go high. So, and then you
And
look at
that's
the
all
US
going to be
dollar.
in the financial markets. Ultimately, that's where the liquidity gets. That's where it's been absorbed for the last 10 years. It's not going to stop. There's no indicator for it to stop. Let's go to China, Clyde, and get your thoughts. Obviously, we're in the China New Year week. There's a lot of sort of holiday time in Asia or China and so forth. Where's the outlook? What's the impact there in typical trend line for first quarters in China?
Well, I mean, as you're right, with the Lunar New Year holidays, nothing's going to happen this week. It will take a little while for things to pick up once they all get back. In general terms, as far as commodity imports go, the Chinese have been buying quite a lot. If you're looking at oil specifically, they weren't the refiners, or they get quotas. Their quotas weren't any more for 24 than they were for 23. The difference is they got them all up front. So what that does give them is a lot of flexibility. They don't have to buy within certain calendar periods. They can buy as much as when they see prices are cheap and as little as when they see prices are expensive. So that's kind of how I expect things to go as far as oil goes. It's also a very easy win for China to boost refining. It gives them a nice economic kick straight away. And at the moment, product markets are still quite strong in Asia, especially for diesel. So they're incentivized to import crude and produce it into fuels and export those fuels again. So I expect that trade will continue for a little bit of time. But the rest of the Chinese economy, yeah, it's not looking so good. It is exporting deflation to the world. I expect that will also continue. Will it be enough to prevent a renewed inflation round in the West? I probably not. But it's kind of interesting that China is sitting in a very different spot.
Typically, Clyde, China goes into the Lunar New Year holiday having bought bought a lot of imports, bought a lot of oil, and then it sort of flattens out. I mean, is that a cycle in play this first quarter as well? That big buy in the first month and then soften for the second and third?
It does depend on where the Lunar New Year falls. If it falls quite a lot in January, then there tends to be a push back into February imports. If it falls in, as it has this time, entirely within February, then you do find a pull forward into January, especially on short dated or short delivery commodities. So stuff that they can get from Russia. In oil, that would be, like ESPO oil from Russia, but also coal from Indonesia and things like that. So there's probably been quite a bit of pull forward into January. You might see slightly less in February because of that. But if you actually look at, overall, as long as the prices that they're getting are still reasonable, and for oil, that means probably, up until at least April, they might be importing quite a lot. The recent price rises will start to be felt from sort of May onwards.
Brian, last word to you. You mentioned in your earlier comment the outlook for U.S. oil production in the year as a whole, and obviously every a month it needs to add just to stay in the same place in terms of depletion. But what about your outlook for the other parts of the Americas, Canada, Mexico, Guyana, Venezuela? Could we expect a lot of new supply from there in the quarters ahead?
So Canada, definitely. Mexico, I'd probably see as probably stable to flat. Guyana, that one I'm watching. I don't think that's going to be a rapid development. That might not be a 2024 story in my view. It might be more of a 2025 story. Venezuela is kind of grinding up a bit, but I think Mexico is probably going to be flat. Growth in Canada might actually be a lot stronger on a percentage basis than the United States. So that's the one that I'm watching right now. Now, a lot of their rigs may be deployed because of the export LNG facility on their western coast that is expected online within the next 14 months, and that is going to be a significant development. But most of the rigs are dedicated for new production that is going that way, not so much crude production, because Canada, you either need to produce the gas or the crude. It's not both. So you either use the gas to get more crude or drill only for the gas. So that's what I'm expecting.
Well, certainly OPEC Plus would love to hear your analysis and believe in it, because if the Americas are flat in terms of their additional supply this year, that would certainly be great news for OPEC Plus, because that would give them some chance to maybe pull back a little bit from their steep cuts, and that will be an interesting story to watch, at least on the supply side, as compared to where is demand going. We're going to have to leave it there. As we say, oil prices starting the week a little bit flat after a big run up last week. Will that run up get some mojo as Europe and the Americas open in the coming hours? We'll have to wait and see. Thank you so much, guys. Great to have you back on the program, and have a great week. Omar Najia in Dubai, flooded Dubai today. You're going to swim down to the local Starbucks because they're not delivering. They're just not delivering today. Clyde Russell, of course, in Australia. Lovely to have you. Thanks, Clyde, for your insights today. Brian Pieri in Colorado. Take care. Have a great day. And we'll catch up every morning, 10:30 UAE time. All the best. Thank you.
Thank you.
Thank you.
Thank you.
Bye-bye.
Cheers,
Bye.
guys.